everyone. Welcome to The Trade. Nice to be here with you. Let's get across what traders are watching now. And Russia has fired a hypersonic intermediate-range ballistic missile at a Ukrainian city of Dnipro on Thursday in response to the US and the UK allowing Kyiv to strike Russian territory with advanced Western weapons. A further escalation of the 33-month-old war. Oil climbed nearly 2% as those tensions rose between Russia and Ukraine. So worrying about crude supply if the conflict continues to escalate. Spot gold rose for the fourth consecutive session, hitting an over 1 week high. Safe haven demand soared following Nvidia's lackluster revenue forecast and those concerns about Ukraine-Russia relations. Copper prices retreated on concerns about the latest developments in that Ukrainian war. Firmer dollar as well weighing on copper, as well as worries about demand in China. And if you've had your cup of joe this morning, keep this in mind. Arabica coffee prices hit 13-year highs as the market remains concerned about regulatory risk, the extent to which top producer Brazil's crop might recover next year, and as it digests bullish demand signals. I need a coffee. Wrong time of the day for Ilya Spivak from tastylive to be having a coffee. He joins us from SF. Hi, Ilya. Nice to see you there. Okay, U.S. dollar ascendancy. Is that baked in until we know more about the Trump presidential, appointees?
Very good to be here, Nadine. And just for the record, it is never a bad time for a coffee for me. I don't even know which time zone I live in anymore. The situation with the Trump trade is absolutely on my mind here. And really, it's a broader narrative. We've had this happen for 2 months now, really, since the beginning of September, once the markets were convinced that the Fed is going to start cutting rates. And once they actually did, what we saw was a strengthening of the dollar, a rise in yields, a pickup in break-even inflation numbers in the bond market. And all of that seemed to say that the market looked at what the Fed did, looked at the dovish forecasting they offered and said, well, the economy isn't doing badly, and this stimulus will be reflationary. This will trim your capacity to cut rates in 2025. Let's shift up yields. Let's shift up the dollar. And that move has been with us for 2 months, and of course the election helped because the victory for the former president here means, I think, as far as the markets are concerned, at least from the tariffs side of it and the crackdown on immigration, a disruption to labor markets, and essentially a sales tax on imports, all of which just compound inflationary pressure further. And so the first chart I have here for you is that of the euro. And you can see here the way it's been sinking against the US dollar since these moves really started to come to a head. What's interesting is that perhaps we have all the information on these narratives that we're likely to have near term. We still, of course, need the announcement of a Treasury Secretary appointment. Maybe that comes tomorrow, but the move appears to be getting exhausted. What you see on the bottom there is a momentum indicator. This is the relative strength index, but any one will do. And what you see is as the price is trying to grind through those lows from 2023, right around the 105 figure, a little bit under and a little bit over, you start to see a kind of divergence in momentum where you're setting lower lows, but momentum isn't mirroring that. And that can be the precursor to a turn. So it's possible that we could have a euro bounce here and a more general US dollar pullback, not because the narrative has fundamentally changed, but because speculative appetite in the narrative has hit a wall for now. We don't have any new information, and so we might have a bit of a correction, not unlike what we saw in late September there from the bounce 108 to about 109 and change before the next leg.
Yeah, all right. So interesting. I can see that there with that RSI at the bottom, the relative strength indicator. So how do bond yields help, I guess, confirm that narrative?
This is very much a parallel story. The rise in interest rates from early to mid-September, the rise in the dollar early to mid-September, very much parallel moves, and much of the action, of course, at the long end. And a steepening of the yield curve, essentially saying, yes, the Fed is going to cut now, but at the longer end, yields should go up because the Fed is not going to have, in this reflationary environment, as much scope to ease. That same sort of positive divergence that you see in the Euro chart we just saw, we likewise see here in the 30-year bond, suggesting that right around that 115 level, you might be starting to carve out some kind of a bottom. Notice the last big red candle there, that's the election. That's the market saying the ascendancy of a Trump administration is probably an inflationary thing. And since then, we've kind of idled, haven't gone very much at all, and just kind of waiting for the next shoe to drop, which again, with a lot of the news out of the way, the Fed out of the way until the December meeting, the election outcome in the rear view, a lot of the data in the rear view, the big releases, we get the possibility that the markets are just out of speculative juice. And if you were to leave open some room, they could correct higher before the next move. The trend certainly seems pointed lower. I don't think that changes, but markets don't move in straight lines. And so there might be an opportunity here for a bit of a backfill before the next decline is going to start.
Okay, but if you take what we've just learned about both the euro dollar and bond yields, what picture does that paint for gold?
Gold is a really interesting asset in this environment. And what you were just saying before you and I kicked off here about geopolitical risk certainly is an important consideration. As is the general sort of reflexive demand for gold in times of uncertainty. Note here that peak at 27.08. That's the moment where the Fed issues those rate cuts and the markets take them as inflationary. The dollar starts to rally, the bond starts to sell off, and yields go up. Gold doesn't have very much of a decline. It wiggles lower a little bit into the beginning of October, and then there is this strange rally, which doesn't really seem to make much sense because gold is a natural foil for both fiat currency, as epitomized by the dollar, and yields, because gold yields nothing. So very strange to see gold rally when yields and the dollar are going up. That should be an environment that's akin to kryptonite for gold. Nevertheless, it rallies into the 2,800 mark and then pauses before cracking right back down as the election outcome is revealed, suggesting maybe that was uncertainty that was veering it off into some sort of strange anti-macro dynamic. And then once the uncertainty is relieved, the metal basically readjusts to where it should be. Notice after those big 2 red days, it's right back to where the Fed left it, as though it didn't go up from 27 to 2,800. It's back up now, ostensibly, geopolitical risk a factor here. That bottom around the swing lows last week, that's Fed Chair Powell saying, yeah, actually, maybe not as many rate cuts next year. So maybe we've exhausted that bit of the news, but the geopolitics has lifted us. So we're sitting at this resistance now about 2680 or so. There's maybe room to backfill above the 2,700 figure into 2722 or so is the top of that range. But if next week's FOMC minutes and the PCE data that the Fed cares so much about, if that gives us a sense, yeah, maybe fewer rate cuts than we think even now, then this could once again snap right back in.
Wow. Oh, you have really explained that well, Ilya. I think anybody, even who doesn't normally follow the charts, could go along with that story. So we're just out of time today. Always a pleasure to see you. Thank you so much.
Thanks very much, Nadine.
Ilya Spivak, has this specky run out of juice in some cases. Something to think about. That's the episode of The Trade. Back in just a moment.